Yeah, good morning, everybody. Happy New Year. Here from Frankfurt, from the Sino-German Center. You are most welcome to our first webinar in 2025. As always, I'm together here with my colleague in the board of the SGC, Rüdiger von Rosen, and I'm also happy to welcome our speakers today. Frau Dr. Julia Haes from the China Institute of the German Economy, and Dr. Yi Xiong, the Chief Economist of Deutsche Bank in China. And Rüdiger will later introduce them, both speakers, more in detail. Let me give a minute for a short introduction in the topic. We are looking for the future of Chinese economy in 2025, which of course is a very interesting one, exciting one. The result of 2004 are more or less clear. We will see a growth rate close to 5%. However, the overall economy is still relatively weak, especially the private demand for consumption and investment. The inflation rate is very low, close to deflation. And yesterday it was announced on the other side as China has reached a record high in the trade surplus, which is probably especially a kind of a challenge for the new American president. From the policy side, we had in the beginning of December the Central Economic Working Conference, and the main decision has been to push forward more domestic demand with more proactive fiscal policy as well as with a more loose monetary policy. So we have to see whether this will work out in the next year. Of course, we have a lot of uncertainties, not only in the domestic economy, but of course also internationally. As we all know, the inauguration of President Trump will take place in some days, and we don't know his policy yet really with regards to China and other countries. So we have to consider this. Yeah, having said that, I hand over to Rüdiger, and he will introduce the speakers. So Rüdiger, the floor is yours.
Happy New Year from my side as well. We start with Dr. Yi Xiong. He is Chief Economist of Deutsche Bank in China. After an interesting career with the International Monetary Fund in the 2010 to October 2017, he joined Deutsche Bank as chief economist from October 2017. He has a PhD from Beijing Peking University, doesn't really matter. And we are extremely interested in your views. It's chances and challenges and expectations and realities, of course, we are talking today about. And I think it's for all our participants here of great importance to hear the voice from the Chinese side and to listen carefully to Julia, what are the expectations of and they are crucial expectations of the German side. So please start, Dr. Yi Xiong.
Thank you very much. Hello, everyone. It's my pleasure to be here again to talk our view on China's economy at the beginning of the year. Now, I think it has been quite volatile years over the past few years with unexpected events along the road. But even with those in mind, I think looking at 2025, this could be easily a year with even more volatility, even more possibility of unexpected shocks to both Chinese economy or maybe to the global economy. So I think to begin the discussion is to recognize there really are a lot of uncertainties. So when we talk about forecasts, I think it's more about looking at the relevant issues for the Chinese economy this year and how we see things could be evolving, but also recognizing that things might not as played out as what we're expecting today, and we really need to adapt to the reality along the way. Now, thinking about China's economy, I want to touch upon three issues which I think are most important for the performance of the economy this year, or maybe even down the road, going beyond this year. The three issues, one is with regards to China's property sector. which has been in downturn for almost 4 years now. And what happens to that sector this year will be crucial for China's economy, especially domestic demand and also consumer sentiment. The second issue I want to touch on is the US-China trade relations, or frictions, more likely, that what will likely be President Trump and his administration doing with China exports, and what will be the likely impact of that on China's economic performance. The last thing is taking into account of these factors, what kind of policy response we will be seeing from the Chinese government. Let me dive into the first topic, the China's property sector. We all know that it hasn't been performing. It has been in a downturn for since early 2021. And over the past 3 years, each year we are seeing both declines in prices and declines in the sales of new homes. And that is really having a negative impact on China's economy, not just because the sector is very large. It has a lot of upstream and downstream connections with domestic demand, but also that we do have a lot of Chinese households with a significant portion of their assets invested in the housing sector or housing ownership as part of their wealth. And the drop of prices of housing is having a negative impact on the sentiment and on the consumer's willingness to spend. So what happens there is going to be crucial to watch. I think there's no crystal ball in terms of forecasting what will be the end result of the sector's performance. But I think when we look at this, it's more through the lens of how China's property sector downturn compares to what we see from other economies. And I looked at maybe 30, 40 different property sector downturns happening over the past 3 decades in different countries, from larger ones like United States to some smaller countries. And here are the things I tend to find out. One is that when you have country entering a prolonged private sector downturn, then on average, it will last 4.5 to 5 years for property prices to reach a bottom and rebound. So in that regard, if we look at China right now in its 4th year, not the 50 years yet, maybe there's still some way to go for property prices to decline. And from a supply-demand angle, seems to also support that conclusion, because you do have still a lot of home listings, both in the new home market and in the secondary home market. And it still takes time for those listings to be absorbed by the volume of transaction, which as of today is on the new home market is half from the peak level we're seeing, maybe better in the secondary home market, but still, I think the oversupply issue is still there, which will still put downward pressure on prices. But I think another part of the story, which we could start to see some change, is maybe on the transaction, on the volume, and maybe even the value of transaction on the property market. And that is because you often hear people say that when you have property prices dropping, then people will hold back their purchase and you wouldn't see a recovery in housing sales. But what we actually tend to see from other countries is that in this kind of deep property sector downturn, you will have observed housing sales recover maybe half a year or 1 year ahead of the bottom of property prices. And if we do think China's property sector downturn will last similar to the average length of other deep property sector downturns, meaning 5 years, then maybe this year is the time we could be starting to see a bottoming out of property sector transactions, new home sales. In fact, we already see some positive development in sales of both new home and secondary home markets over the past quarter or so, and on the back of government relaxing further on the policies. So what will happen here, we still need to observe. The first round impact of those easing might fade out, but eventually, if prices have come down a lot and housing has become more affordable. On the other hand, we also have down payment has been cut, mortgage rates has been reduced a lot. So housing affordability did have improved, and people who are actually buying house today, they're not looking at it as an investment, but really that they see the need for improvement of their housing, or they have migrated and it's time for them to buy a house from the places they now live in. So I think we could be seeing maybe some stabilization of housing transactions, whereas at the same time, there could be still some time to go for prices to reach a bottom. So it's not an all positive story, but compared to in the past few years where both transaction volume and prices are dropping, there could be less of a drag to growth coming out from the property sector. The second challenge, obviously, is the US-China trade frictions. And on that, our view is one, tariffs are most likely to come, and it will probably come sometime this year. But two, we also tend to think that the threat of, let's say, 50-60% tariff hike will not be realized on day one. I think what the approach we will more likely to see is a gradual one, that we will see maybe the US gradually increasing the tariff on Chinese products for two reasons. One, it will not have large impact or disruption to the US consumer market and also US inflation, which I think the US administration would want to avoid. But also two, that if you put too high prohibitive tariff, then exports will just disappear and there will be no revenue to be collected from those tariffs. So from those two angles, I think a more gradual approach, increase on tariff, let's say 10% in tranches, could be the more likely outcome. So our forecast assumes maybe a 10 to 20% tariff hike before end of this year, and there will be more uncertainty next year and beyond. Now, if you look at the exposure of the Chinese economy to US consumers, US final market, it has been on a declining trend over the past 2 decades. At its peak, at around 2008, 2010, exports to the US accounts for 10% of China's GDP. The number has come down to only 3% as of last year, not just because China as a whole is shifting more on domestic demand relative exports, but also because the relative share of US in China's total exports has also dropped. You're seeing that Chinese companies are, especially over the past 5 years, increasing a lot of their exports to the emerging markets rather than US or the developed markets. And that is a structural shift still happening. So from that perspective, that the impact of a second round of trade frictions on China's growth could be somewhat smaller compared to the first round. My estimate is that maybe we will see a 0.5% negative shock on China's headline GDP growth in this year. So I think it's definitely a headwind, but it's something that not too catastrophic, and also Chinese companies have seen it in the past, so they are more ready this time to deal with the impact of increase in US tariffs. Now, even with that in mind, I think the two things we mentioned above are still more likely headwinds than tailwinds for China's growth. Just in the past year, 2024, China's growth was, I think, very likely 5% by my forecast, but 1% out of that 5% growth is coming from external demand. So you do need, if the government want to reach another 4.5% to 5% growth in 2025, given that 1% external demand contribution will likely be gone this year, you still need a lot more efforts into boosting domestic demand in China. Now, with that, I think a key observation is that the whole macroeconomic policy in China has experienced a significant shift in September last year. Before September, I think we've seen more measured policies aiming at boosting domestic demand. But at the same time, the government, for example, they do face a loss in revenue. So their spending has been declining in the first 8 months of 2024 as a result of the dropping in revenue. But since September, we've seen a dramatic shift. Now the government's spending growth in the last 4 months of 2024 is likely a double-digit positive growth. So that big switch in spending alone tells us that the government is making a big change in its overall policy stance. The same thing for monetary policy, that in December, the annual conference, we did see that the official monetary policy stance has changed from prudent, which has stayed there for the past 15 years, to moderately loose, which was the stance we saw back in 2009 and 2010. during the global financial crisis. So both fiscal and monetary policies has shifted, and I think when the economy is still facing the challenge of insufficient domestic demand, of deflationary pressures, it is really fiscal policy that will have a bigger multiplier, that will have a more visible impact on both demand and prices compared to monetary policy. So we will know what will be the total government fiscal stimulus package in early March when the government announces the budget for this year. But in my forecast, I'm building in 1.5% to 2% increase in overall fiscal deficit. And my calculation shows that if that is indeed the case, then we should be seeing Chinese government spending growth of around 7 to 8% this year. That would be higher than the GDP growth this year, which wasn't the case last year. Last year, even with the change in the fourth quarter, total government spending growth is just around 1 to 2% lower than GDP growth. So I think that is really the expectation of government changing its stance could bring some visible impact on domestic demand, and also that would helpfully give us an upward boost in consumption. We also saw that on the consumption front, on the prices front, with the government increasing spending, but also providing more subsidies for consumer items such as cars and home appliances, the core inflation in China has stopped from dropping, and it did inch it up a little bit, some consecutively in the past few months. So from a on the ground perspective, I think things are still not very good, but it seems to have passed really the bottom and is starting on a path of improvement. But we also recognize that there are headwinds ahead. So the government indeed still need to keep the policy support, and they cannot afford that to have another growth slowing down and people again losing confidence in the future growth and their income. So I do think the challenge still persists for the government to deliver their support to the economy. But if they can really deliver on that, we could be seeing China finally having a stronger domestic demand, but also some turning point in its inflation. Let me stop here.
In any case, the situation in China is so much better than in Germany, as we know. So we are very much looking to these approaches. And later on, of course, we are discussing how much our European and the US economy is depending on each other. Is there a possibility to switch from one partner to the other, and how much is China depending itself on all these exports to Europe and the United States, for example. Our next speaker, and most welcome, Julia Haes, one of our champions in the Chinese-German relations, working intensively since 10 years in this field. She has a PhD from St. Gall, our in a way Swiss not counterpart, but we are quite in competition in business schools, and the Frankfurt School is approaching in this direction to quite an extent. She did a lot of work at the Free University in Berlin on cooperations in the academic field with Chinese universities, and founded her own company, which gave academic education for Chinese. In 2021, she has founded the China Institute for the German Economy, quite important, and is teaching at Munich Business School Business in China. So Julia, we are very much looking, you are very associated with the Sino-German Center since years, and we are happy to have you here in our steering committee. I'm very much looking forward for your remarks and later on for the discussion. Thank you.
Thank you very much for this very kind introduction. And yeah, let me just jump in. Dr. Li has already touched on many points that I will also touch upon. So let's first start with GDP GDP growth last year. The official numbers are not out yet, but the Chinese government has said a few times that it has actually reached its goal around 5% for last year. And like Professor Löchel already said, a big part of that were the exports. Last year, China had a record trade surplus of 990 billion US dollars. That was even higher than the previous record of 2023. So this trade surplus makes around 10% of the Chinese economy. And of course, although the official targets are not out yet, they will be out in March. We expect again that the Chinese government is aiming for about a 5% GDP growth in 2025. And the question is, of course, can this target be reached? Dr. Li already mentioned a few critical issues. I would like to talk a little bit about exports, then domestic consumption, and also government investments. China has been criticized for its overcapacities by quite a few other countries. Some of these overcapacities are exported because domestic demand is too low for this. And what I find very interesting is we expect these overcapacities in certain areas, but they also pop up in some areas that we might not expect. So, for example, last year, the Chinese government started an investigation into EU pork exports. And then I looked at this industry a little bit. China imported 4.5 million metric tons of pork and pork products in 2020. And the imports have gone down by 2/3 until 2024. Because many SOEs, but also many private investors, private business, and even private investors started investing in this industry. They have invested in pig pens. Some companies even have built their own pig pens on their production sites. So all of a sudden, the domestic production grew considerably, which puts pressure onto European swine farmers, particularly in Spain. So what my point from this first example is, Chinese businesses, German businesses, excuse me, must stay informed about what's happening in their industry in China. Because even if you don't expect it, if it's maybe not a very innovative industry, it could still be that overcapacities are creeping up. So it's definitely very important for German businesses to watch the Chinese market. Let's quickly come back to tariffs. Europe has established tariffs on Chinese NEVs, as have the US, and President-elect Donald Trump has announced that he wants to impose more tariffs. Of course, in the past, these tariffs were maybe not as effective for the US as they had hoped, but that's a different topic. Anyway, anything that is not imported into the US any longer, China will try to export to other countries. So we have already seen that some other countries have also responded with protective measures. Just last week, the Chinese Ministry of Trade announced in its China Trade Remedies information that Chinese trading partners have started 160 trade investigations into Chinese products. This was a significant increase compared to 2023. And so we have to expect that many other countries will also try to put in place protective measures, which makes the situation more difficult for China, but also more difficult for Germany, who, I mean, we are also a country that exports a lot. So, of course, the question for us will be, how will China react to these 10% tariffs, US tariffs? Will the yuan be devalued again as in the past? This brings both challenges and opportunities to Germany, because on the one hand, German businesses and also consumers can buy Chinese products more cheaply, which if we look at certain areas that are very important to us, like let's say our energy transition, this is a chance for us to buy, for example, quite cheap solar panels, different from oil that basically is used up and then we cannot use it any longer, solar panels can be used over and over to generate energy. So it's not as, we will not be as dependent from China if we buy solar panels. In fact, why don't we use Chinese subsidies to help finance our energy transition? So I think that's a big opportunity for us. Of course, if you are a German business competing in these areas, it's more difficult because Chinese competition is fierce, and we have to innovate, we have to look at our strengths and develop additional services that we can use to stay competitive. So let's move on to domestic consumption. As Dr. Li already said, the domestic consumption has been low for the last few years since the pandemic. China started several rounds of economic boosts, but they have not unfolded as much as the Chinese government liked. In December, there was a big package announced with measures to strengthen domestic consumption. Like Dr. Li said, the numbers are not out completely yet, but it is expected that there will be more trade-in programs, and those trade-in programs could be extended from NEVs and home appliances to furniture, home decorations, home textiles, and consumer electronics. And I have also seen that there are discussions to introduce a childcare and birth subsidy system with a considerable worth. Some local governments have already put aside some money in their budget, but it's not clear yet what this support program will look like, and they are waiting for the central government to clarify what's expected. So we see that the central government has shifted towards stimulating demand, but of course the question is, again, is this sufficient? The stimulus will be financed through ultra-long special government bonds, so local governments will have access to fresh money, and they can refinance their existing debt, which will lower their interest rates. But of course, the question is, will they really make new investments or rather manage their obligations? And I want to give you one comment, a very personal experience. My colleague just returned from China, and she talked to a lot of her friends in second-tier cities. In her hometown, several friends who work for the government said that they have not received salaries for 6 months. So basically, they have lived off their own spendings, their own savings. And I know that this happens sometimes with private companies that are financially in trouble. And we also know that in the past, local governments have done salary cuts for their employees, but really no salary. That's quite a sign. And it's, of course, for these people, it's very difficult. Their savings will be spent, and this does not necessarily boost confidence in the government. Unemployment is still high, particularly among young people, probably higher than the official numbers. And with many companies operating with losses, maybe even on the brink of bankruptcy, unemployment could even get worse. So the government tries to boost the confidence, not just by measures, but also with propaganda. In preparation for the Spring Festival celebrations, local authorities were advised to give handouts to poor people and also quickly resolve disputes and make every effort to maintain social stability. So they are aware and they are paying attention to the consumer sentiment. So is the situation already getting better? Of course, we hope this, but we don't know. I would expect that private consumption will remain low, as people will stay cautious as long as salaries and thus disposable income do not grow. And the support programs mainly support short-term consumption, but if they can really support long-term consumption is not clear yet. So my third conclusion for German businesses is conditions in the Chinese markets remain difficult. They are not improving yet in a way that we can really say it's already on the upturn. And as the third pillar of the GDP, we have the investment activity. 2025 is the final year of Made in China, the Made in China 2025 industrial plan. And China has already reported in the spring of 2024 that it has reached 86% of its goals and will almost reach all the goals by 2025. And of course, most of these goals were, I wouldn't say relatively easy to reach, but they were at least credible and within reach, let's say reaching certain capacity amounts and so forth. Many observers said that the qualitative, the hard to reach goals, such as building up a fully functioning semiconductor ecosystem or building its own planes, are much harder to reach, and China is far away from these goals. The US government under Joe Biden imposed chip embargoes to slow down China's development in the high-tech fields of the future. And of course, China is able to produce simpler chips in high numbers, and these chips are used in millions of devices. But to really make advances in areas like AI, you need these cutting-edge chips. Although that was maybe something of the past, because last week, a relatively small and unknown Chinese startup, a company called DeepSeek, announced a new large language model that operates at about 1/70th of the cost of a GPT-4's expenses and shows a similar performance. And I'm not an expert on semiconductors or AI, but from what I read, it seems that this system operates much more slenderly, more cost-effective, uses less energy, and therefore, and it also can rely solely on this H800 chip, which is not the latest technology, and which, at least until last year, was still available in China. So DeepSeek was founded in May 2023 with the support of a Chinese hedge fund, and in just 2 years, and under most difficult conditions, this Chinese startup was able to achieve a groundbreaking and cost and performance innovation that will make China more independent of US produced chips. And DeepSeek at the moment is only focusing on research, not on applications, but still this innovation has the potential to really make China independent of US chips, and it could really change the whole situation. Because American dominance currently rests on 3 pillars: excellent research landscapes, which China has as well, access to the best semiconductors, which China doesn't, but maybe which China doesn't need in the future, and enormous computing capacity, which China might also be able to bring down significantly with using these less developed chips. So China has the potential to become a global innovation leader in areas, we know this already, areas such as electric vehicles, drones, and solar energy, but maybe also very soon in AI. So China really has moved from the copycat and from the process innovator to a real innovative country. We see that it's not just made in China, but more designed in China in ever shorter development cycles. And so I think it's very understandable that many foreign companies stay in China, want to stay close to the development and the innovation. And we see this with many German companies, for example, that are now opening or strengthening R&D departments in China. So my fourth conclusion is mostly a reiteration of the third. The condition in the Chinese market remain difficult for foreign companies. Competition stays fierce. China will push for innovation and more independence, and German businesses still have to stay there to be close and to watch what's happening. So overall, I think we must prepare for a significant change of the European and particularly German economy. We cannot rely on tariffs or on other protective measures, and we shouldn't. We need to realize that our biggest markets, the US and China, changed dramatically. And we don't know exactly yet where this is going, but we have to watch much more closely than in the past what's happening in the US and in China, both politically and economically. And then we have to adapt our policies and business models accordingly. I think we still have strengths and advantages that we have to play out, that we can and should use. And I know that we Germans don't really like change so much, but we don't have a choice. There's no alternative. And I think there's also a big chance to adjust our trajectory and just, use our advantages to be successful in the next decade and beyond. So with this, I would like to close my remarks. Thank you very much. And I look forward to the discussion.